On December 14, 2025, the Bittensor network reached a critical threshold. Total TAO issuance crossed 10.5 million, triggering the protocol's first supply halving. The immediate protocol effects were mathematically precise. Daily network emissions dropped from roughly 7,200 TAO to 3,600. The annualized inflation rate was cut from 10% to 5%. Looking at this chart tracking TAO's price, the market reality diverged sharply from investor expectations. TAO traded around $290 on halving day. 3 months later, the price had plummeted to $190, a 33% decline. It was a textbook sell the news event. Even the S1 filing to convert Grayscale's G-TAO Trust into a spot ETF in late December only managed to generate a brief price spike that the market quickly retraced. The price decline reveals a deeper issue with network behavior. The D-TAO upgrade promised to turn every TAO holder into a decentralized venture capitalist, actively allocating capital to productive subnets. This chart reveals a glaring failure. 10 months after D-TAO launched, the second halving is estimated for December 2029, but active subnet registrations will inevitably push that date further out. Mathematically, this first TAO halving is its most impactful. The absolute reduction in new supply shrinks predictably with every subsequent cycle. Because TAO's supply schedule constantly reacts to network usage, analyzing it as a passive store of value leads to false conclusions. It must be evaluated as a competitive utility ecosystem. To understand where the emission cut actually occurred, we have to isolate the mechanics of the February 2025 D-TAO upgrade, where each subnet received its own alpha token traded through an automated market maker. Newly minted TAO splits down 2 paths: direct rewards to nodes and alpha token injections into liquidity pools. The critical nuance: only alpha tokens injected into subnet pools were slashed by 50%. Direct rewards to validators remained completely untouched. Compounded missed liquidity squeeze was the late 2025 MEV Shield update. Implemented to stop front-running, it made the transactions within this newly slashed liquidity pool highly contested. The protocol engineered a very specific dual-layer shock. It successfully shielded individual node operators from the halving while aggressively starving the application layer of its liquidity. The final piece of the post-halving environment arrived a month prior with the November 2025 TAO Flow protocol update. TAO Flow discarded the old system of equal distribution. Instead, it enforced a strict flow-based model where subnets receive emissions proportional to their net TAO inflows. The penalty for losing capital is severe. Subnets experiencing net outflows now receive absolutely zero network emissions. Severe resource restriction violently forces capital to consolidate into highly productive hubs, leaving the weak nodes to completely die. This topology graph maps the 3-month data. The subnet chutes secured massive success, hoarding 9.3% of emissions. Middle-tier survivors, like Gradients, maintain steady performance. Compare these to zombie subnets like Tiger Alpha. Starved of capital inflows, it faced deregistration. Under the high emissions of the pre-halving environment, mediocre subnets could survive comfortably just by capturing the overflow liquidity. The subnets that survived secured a massive first-mover advantage. Because they launched before the halving, they permanently locked in their initial liquidity at double the current injection rate. Any new subnet launching after December 2025 faces a steep structural disadvantage, making the path to bootstrapping enough liquidity significantly harder. The combination of TAO flow and halved emissions acts as an aggressive, highly efficient viability filter, systematically purging the network of unproductive inflation farmers. Historical Bitcoin data suggests supply shocks take 12 to 18 months to fully price into the market. TAO investors cannot rely on that timeline. Bitcoin operates as a fixed-function monetary asset. TAO is dynamic infrastructure processing AI workloads. It must eventually prove measurable utility. The uncomfortable truth about Bittensor's current state is that it generates zero external revenue. It operates entirely as a closed economic loop funded by internal inflation. Over the next year, there are 5 critical metrics to watch. Metric 1 is subnet revenue development. Dominant hubs like chutes must begin charging external users for inference to generate actual cash flow. Metric 2 is alpha staking migration. Watch to see if that stagnant 72% root staking ratio finally shifts toward an even 50-50 split, proving holders are actively curating subnets. Metric 3 is the subnet attrition rate. A healthy network functioning under restricted emissions should see a 30 to 40% deregistration rate of zombie subnets. Metric 4 relies on institutional catalysts. The pending S1 conversion of the Grayscale Bittensor Trust into a spot ETF has the potential to open massive passive exposure. Finally, metric 5 is the recycling rate effect. Monitor network registration activity to track how much TAO gets recycled, which will physically push the 2029 halving date further into the future. If the subnets simply run the exact same emission-dependent loop at half speed, the halving is a non-event. True success requires this pressure to force actual external revenue generation. This analysis is from Own Your Mind at ownyourmind.ai, an independent research platform covering decentralized AI.